Welcome back, everybody, to the Informed Homebuyer Podcast. I'm your host, Rich Curtis, and I've got my co-host here with me, as always, Dave Miller. How you doing, Dave?
I'm good, Rich. Thanks for having me.
All right, we are here to give an update on what's going on with the economic insanity in the United States and whether that is leading us down the path to recession. And sort of on brand or on theme here with the economic insanity, we sort of had to throw out the plan right before we started this podcast because of a major announcement Trump made and another major swing in the market. And I won't steal Dave's thunder. I'll let him explain what that was. But suffice it to say, we are in an environment where things change by the day minimum and by the hour very, very often. So what are we going to cover today? We're going to cover what happened, how the stock market reacted after the last tariff announcement, and what that meant for mortgage interest rates. We're going to cover what just happened today, how the stock market's reacting, and what that means for mortgage interest rates. We're going to cover whether we're heading for a recession, why the risk of recession has been bumped up from 15% to 60% likelihood in the last 2 months, and what a recession would look like this time in the housing market, and how you can prepare, where there's opportunities for you and where there's risk that you should avoid. So should be a great episode to help you make some high quality housing decisions. With no further ado, I'm going to push it over to Dave to walk us through, Dave, what has just happened after the last tariff announcement up to now in both the stock market, the bond market, and its result on mortgage interest rates.
All right, Rich. Well, I think where I'll start here is, I think on the last podcast you mentioned that maybe I wasn't politically correct and I used the R word, which you defined as recession. And typically, we avoid using that word because it sounds pretty scary, but we're just throwing it out there now. Now we're just using the word potential for recession. There's no abbreviations here. So
nobody's hedging anymore. It's just out there in the narrative. We are on our way.
Right. And so, we do these podcasts here and we're, ready to present data. So I was prepared to come today and talk about, what has transpired with the market, where interest rates were compared to yesterday to today. Right now, I got my phone, I got two computers because things are changing so quickly. Like I literally have to look on my phone to see how the stock market is moving. And so let me give you an example. So when we opened up today, the first thing I look at in the morning is the bond market. And which the 30-year mortgage-backed security, which is going to dictate where interest rates go. So I look at the bond market and I look at the 10-year T-note. Looking at the bond market this morning, let me back up. Yesterday, we were down. Yesterday, we were down from the previous day. We closed down at 99.22. So those of you that have seen our bond market chart, we're using different levels. Anything below 99.5, we're below a floor of support and things could potentially go worse. I was shocked yesterday to see it after, 3 days of improved bond prices and seeing interest rates improve. We were in the mid sixes for most borrowers, 6.625, 6.75. Okay, open up this morning from yesterday, and we were down over 100 basis points from yesterday. So we opened up at 98.84 and got as low as 98.19. So then I turn around and I go look and see what interest rates are doing. They were over 7% in a day. It's crazy, right? So but at that same time, previous to looking at that, at that same time, I look at the stock market, look at the Dow, look at the S&P. The Dow was up. I was pleasantly surprised. It was up 200 basis points. I thought it was a little bit weird because the announcement of the additional tariffs on China were supposed to go into effect today. And then China announced I think it was a 30-something% counter tariffs on us. So we were going to be over 104% on China. Well, look at the stock market's at, up 200. The Dow was up 200. Fast forward to me and Rich getting ready to jump on this call. We are up over 2,000 points in the Dow. The S&P's up over 300 points. Craziness. So what that did, bond market now shot back up and we gained almost all 100 points that we were down this morning. So Interest rates haven't changed a ton, but now we're going to see it drift. We'll still be around the 7% rate, but there's a chance we could, tick under 7%. So that's a lot of moving parts just in a couple hours this morning.
Yeah, let's break that down so Trump made the first tariff announcement. Yes. Well, not the first. I don't know, it's the 531st tariff announcement, but the Liberation Day tariff announcement on whatever that was, April the 2nd. And we just had sell-off after sell-off after sell-off in the stock market. S&P, I think at one point over 3 days, we dropped over 2,000 points over the course of 3 days.
Well, the S&P was down to, just using a baseline, around 5,000. So the S&P 500 was at 5,000.
Gotcha.
And so, and a lot of traders, a lot of folks felt, and talking to a lot of financial advisors, that 5,000 kind of mark there is a buy opportunity. If we get down to 5,000, we're going to buy, whether your dollar cost average buying, but that seemed like a relatively, a low point based on where we've been. So,
Yeah, it was about a 12% total decline
yes,
from January 1 to a few days after the tariff announcement.
right. And so what triggered that this morning was, apparently the administration came out and announced a 90-day pause on the reciprocal tariffs for everyone but China. So
yeah,
that's what, made the stock market shoot up over, the Dow up over 2,000 points today. So that's a very large swing in a short amount of time. And so,
yeah. So walking it back, he announced the tariffs, it went down, and
yep,
that we saw a little flight to bonds, and we saw the mortgage interest rates improve down to about 6.5% or so.
that is
And
correct.
we were watching that continue, and that was about to be the narrative for this week's podcast. And then yesterday, Dave texted me and says, "Hey, we just lost all of our gains. We're back up to 7%." And we had a little leak yesterday or the day before where somebody tweeted out, or X'd out, whatever the heck you call it now, that there was this 90-day pause, and it wasn't true, or Trump hadn't announced it. So stock market went up for a little bit and then plummeted back down, and that kind of erased some of our gains there. Then come out today, and Trump actually did announce. So who knows if that tweet was, maybe it was a leak. Somebody knew something. Who knows? Trump did announce that 90-day pause on all tariffs except for China, and that made the market soar again. So as of this morning, we were expecting, because last night he had said, I'm putting 105% tariffs on China. And so we expected another bloodbath in the market today. And we got the exact opposite, because at the same time, he came out and paused all the other tariffs for 90 days. So with that pause, market soaring up again, which feels good for our 401ks, but is actually what for our mortgage interest rates, Dave?
Not good, not good, not good at all. So, yeah, and it's crazy because we were actually in a pretty good spot. For anyone that had purchased a home in the last couple of years and was over 7%, we saw, okay, a nice little dip. We got into the, mid to high sixes, and that seemed like a great spot for anyone to take advantage of. And if you watched our previous podcast, we're not expecting fives. We're not expecting below fives. If you can save, we'll save that for a separate podcast. But if you're in a position, where you already are locked in, you have an interest rate, you own a home, and you could better that, it may make sense to lower that interest rate by refinancing. Now, if you don't have a mortgage and you're looking to buy, that's a whole different, scenario here. And we always talk about, short, if the market moves an eighth to a quarter, should make an impact on your decision to buy. You're either ready to buy, and if we're talking 60 or 80 bucks a month, is that going to make a big difference or not? But now we're talking about, a 3/8 to almost a half a point swing in 3 days. So if you were someone that wrote an offer on a house 4 days ago, and maybe you were given advice
Locked in yet.
And hadn't locked in yet. And by the way, this stresses me out when I just look at, knock on wood, I don't have anyone. I advised someone to lock in a few days ago. They took advantage of that today. But the second someone goes into contract on a house is when the stress begins. But if you were someone that just bought a house, or went into contract and you're not locked in yet, this is a stressful time. There's a lot of movement, right, in a short amount of time. Still shouldn't determine whether you buy that house or not, because again, it's 60, 90 bucks a month, whatever that looks like based on your mortgage balance. But this is what we're all experiencing right now. It's very emotional, it's very volatile. And I think the consensus, like me and Rich, we talked about today, is like, this is going to be the norm for a while. It's an emotional roller coaster. And so you could either make the decision that we're going to see this volatility for the foreseeable future. And let's not try to predict, let's not get overly emotional, unless you're in the process of selling your home, buying your home, or buying stock or selling stock. Really doesn't matter, right? Like,
yeah. And I think it's important to point out just how not normal this is. So it's becoming the normal. It's becoming the new normal. But we've been doing this. I've been doing this 20 years. I think, Dave, you're at like 25 years. So like we got 45 years of real estate history between us. And in that time, this is the only time in history that we've seen this level of volatility. Even in the Great Recession,
Hmm.
things were volatile in the sense that, well, they're going down, but they weren't going down, bouncing up, going down, bouncing up. We
Right.
knew we're hosed and we're hosed for a little while and we're going to see it keep
Right.
going this way. And then the
Yeah.
recovery was relatively predictable. We're now coming back up all the way until COVID, basically, was
Sure.
relatively predictable. We saw some uncertainty in COVID, which made sense globally, but this uncertainty is a self-inflicted uncertainty.
Right.
This is somebody, this is your kid. If you've got kids, you've had this experience, you're in the shower and your kid flicks the light switch off on you and you can't do anything about it.
Yeah.
And then you yell them to turn it back on. They flick the light switch back on. You're like, okay, I'm good. And then they flick it off and run and laugh, right? Like this is the environment we're in. We've got somebody flicking the switch on and off, and we can't get our feet under us financially or prediction wise. And that creates what you talked about last time, Dave, with the FUD, the fear, uncertainty, and doubt. That combined with job losses, all kind of segues into the main topic for today is, are we heading towards recession, and what does that look like? And I really liked your opener of where we've all been sort of dancing around and rearranging the deck chairs on the Titanic here, trying not to say recession for a while. And now everybody, in the financial news is just throwing that word around like no problem all of a sudden.
Right.
Um,
And I think the other important point to bring up here, Rich, as we go through all this, I mean, we've rewind here a couple weeks and maybe even a couple months, is our focus has been on the Feds and Fed fund rate and inflation. Like, we haven't touched on that today. We haven't even talked about the Feds, where they're at on interest rate or
right.
inflation. That was our main topic. Like, how is this going to impact that? And typically, some of the things that are going on, as you talk about job loss here, which I think you're going to get to, there's inflationary measures here. So
Yeah, well, it's because we've been in a landscape of talking about traditional economic policy, right? Like, so
yeah,
we've been in this big inflationary cycle globally, despite what people, for partisan reasons, like to tell you was you can blame on one president or the other. The entire world went into an inflationary trend after COVID because of the printing of money and the supply chain issues and all of that. It was an inflationary period that affected the whole world. And we have pretty standard responses. Inflation goes up, the Fed raises rates. If they think the economy is hurting, the Fed lowers rates, right? That's all
yeah,
they can really do. Raise rates, lower rates, buy bonds, sell bonds.
yeah,
That's what the Fed does. And those things are reasonably predictable. And we've been kind of saying the same things about where they're going. We were inching in the right direction over the last year on the podcast here, talking about that. And now, because we've just got somebody screwing with us every day, and there's no real I think there are reasons that have been speculated on, but there's no stated reasons, there's no stated direction, there's no consistency to the policy. People can't wrap their mind around it. And so we are now talking about all sorts of things. I apologize for the sort of financial education aspect that's coming into our home buying podcast. Most of the time in our life, we don't need to know these things. Like, until now, we haven't needed
yeah.
to understand global trade. We haven't needed to understand tariffs and that sort of thing. And I think our comment section after our last one on tariffs kind of reflected that. Some people still struggling, to wrap their mind around tariffs. We've been doing this a bunch. Dave, why don't you give them a little primer on what a tariff is and who actually pays a tariff, and then we'll get
Yeah.
into how that's affecting the economy.
Right. And so whenever we hear the term tariff, we think it's a tax that, when we started this, there was a 25% tariff that we imposed on Mexico and Canada. So for listeners here, and we've already covered this, that does not mean that if we are bringing money in or bringing goods in from Mexico or Canada, that Canada is paying 25% more. That's not the case. Us as consumers, us as manufacturers, us as suppliers inside the United States that are bringing in products from Mexico and Canada, we're paying an extra 25% tax to the government. And when we pay a 25% tax to the government and a company needs the natural goods, the products that they're importing, one of two things could happen. They could eat that 25% tax, or they could pass it on to the consumers. And we know, based on history, I mean, we like a lot of our American-based companies that are selling things to us, but they typically don't say we're going to take a 25% haircut here and just do good by the consumer. That doesn't what happens. So again, when we put tariffs on other countries, it's a tax we're paying inside the United States to the federal government for import tax on those goods and services. So.
Yeah, there's still a lot of disinformation. The president said in a speech last night, again, I hate it when people say that this is a tax on the American people. China's going to pay most of this. We're not a partisan show, but we tell the truth. That's an outright lie. There's no other country has ever paid a dime of a tariff, and they're never going to pay a dime. All that money comes from inside the country, stays inside the country. We are moving wealth from the pockets of the American people into the coffers of the U.S. Treasury via these tariffs. That's the direction of the money flow. There's no foreign money involved in these tariffs.
And to piggyback on that, when these countries come out and say we're going to do a counter tariff, so if they match our tariff and they do a 25% tariff, and let's just use Canada, for example, that means Canadians are paying 25% more to their government in a tax for goods that are imported from the United States. They're not
taxing
paying
their own people.
States. They're not paying the United States an extra 25%. They're charging their own people an extra 25%.
No, so, and that's why this is going to lead to recession, because that money is coming out of the pockets of American consumers, which means we have less money, which means we can buy less. One of the other comments on the last podcast that reflected some confusion about how this works is someone was saying, well, we're doing this because these other countries are tariffing the heck out of us, and we're just leveling the playing field. And again, that's a little confusion based on the way the White House is presenting this. Other countries are not tariffing the heck out of us. What the White House keeps presenting is trade deficits. Here's what a trade deficit is. It means we buy more from that country than they buy from us, which is a natural outgrowth of us being the largest country and largest economy in the world. A great example of this is the little tiny island off the coast of Africa, Madagascar. They produce most of the world's vanilla, right? We buy all of our vanilla from Madagascar. We have like 330 million people or so in the United States. Madagascar has 30 million people. We are the largest economy in the world. They are one of the smallest economies and poorest countries in the world. Trump is now tariffing the hell out of that vanilla so that we have to pay more on it, with the idea that Madagascar should buy as much from us as we buy from them. He's looking for trade parity out of a lack of understanding of what a trade deficit is. There's not a world in which Madagascar can buy as many goods from us as we buy from them. There's actually not a world in which almost any country on the planet can buy as much goods from us as we can from them because of how great our economy was a few months ago. So these tariffs are in an attempt to correct trade deficits. Trade deficits aren't a bad thing. They're a natural outgrowth of us doing so great, of us having such a strong economy. And that's why these tariffs are having such a negative effect. So transitioning to the recession and how it affects housing, when he announced those tariffs on the 2nd, the Liberation Day, we lost 4,134 jobs that week in the country. 19 factories had mass layoffs, 15 closed down completely. Cleveland Cliffs laid off 1,200 workers in Michigan and Minnesota alone. Stellantis laid off 900. Stellantis laid off 900 people. Probably you don't know who that company is. They're an automaker that has a lot of brands underneath them. Brands Dodge, Ram, Jeep, Chrysler, Alfa Romeo, Citroen, and a bunch of other European brands that we don't know or care about. They laid off 900 people just after those tariffs. And this is the main fear for our industry, and the main fear for what's going to go on in the housing market is job loss. So Dave, talk a little bit, you deal with people, you deal with their money, you're in it with them all the way through on these home purchase decisions. When there's this fear of job loss, what do you see in your client pool?
Well, our client pool, if you're a potential home buyer, you get nervous and you pull back. You're less motivated. And here's the thing, there's, since the history of time, there's been jobs added, jobs lost. There's, some industries, there's no guarantee of employment, but oftentimes people are, based on the unemployment figures or a number of jobs out there, you could lose your job one day and on a Friday, on Monday, get a job with another company, maybe doing the same thing, right? That's not the case anymore. So that's where the fear is with the contraction and, unemployment numbers going up, that people are now fearful that, if they lose their job or they're in the process or they buy a home and then they lose their job, then what? So, consumer confidence is very key to the decision-making criteria when someone buys a home. And again, when people buy a home, and we've talked about this, this is also another I think reason why, and you go back and look at one of our previous podcasts, if it's your first time home buyer and you still have a lot of runway of employment in your life, maybe you don't buy your dream home day one, right? Like maybe you buy a starter home and you just work your way up. If you're going to buy stock, you don't go all in and buy it all at once. Maybe you dollar cost average. You hedge a little bit. You're a little bit conservative. You buy the little 2-2 or the 2-1 or the 3-2 based on family size, and maybe 5 or 10 years down the road you trade that in and you buy your dream home. But it gives you a lot more flexibility. So and Rich, and you and I have talked about that. What does this mean for our people now with uncertainty? They're still going to buy a home, looking at lower valued homes. The only way to get a lower valued home right now, unless we see a major decline in value, is to buy smaller square footage, right? Or buy in a different area where the value is less than where you were initially looking to buy. So
buy further out from town.
Yeah. And so we got some announcements coming, in terms of, when the Fed comes out and they speak. So we got jobless claims. In fact, that's coming out tomorrow. And so right now there's whenever we do these jobless claims in terms of, basically unemployment numbers, there's an estimated number and there's an actual number. So, the previous report, there was 219,000 jobs claims. Fast forward, they're expecting or estimating tomorrow to be around 226,000 jobless claims, new claims. So what does that mean? If that number goes up, things are worse, right? If that number goes down, but again, it's a moderate impact. And when we talk about worse than 226, it's got to be a significant amount. Like, if we're at 226, the estimated, and it comes at 229 or 230, definitely worse, but not a major swing. So really, that's why it's a moderate report. Just a little bit of movement isn't going to have a major impact on, the overall, economy on that day. So that's the next thing. And, consumer price index as well. So there's always market dairy reports that are coming out that we pay close attention to that will have some influence on how the market reacts that day.
And those numbers, if I was to tell you as a consumer, the number to watch most closely for signs of recession, it's that job loss, the jobless claims number right now. What's going on in the stock market is definitely recessionary, but it's being manipulated on the day, as you can see by today. Like Dave said, he paused the tariffs, boom, hey, throw the confetti. We're up thousands of points on the stock market. What doesn't go away overnight is all of that fear causing this contraction in these industries, causing them to lay off people to hedge against increased costs, because they don't know tomorrow they could be back on. That doesn't go away, and that's what will lead us down the road to recession. So if we hit a recession, what's it going to look like in the housing market? I think we can take a deep breath there. Is this going to be the correction that we've been looking for in the housing market is the question. And I think if we really go full-blown recession, yes, we'll see a correction in the housing market. Is it going to be the recession or the correction we all hoped for? I don't actually think so, and here's why. Last year was the lowest in terms of sales volume for real estate since 1995, the lowest year in terms of number of homes sold nationally since 1995. And last month, March, we were down in terms of pending home sales, another 5.2% year over year. So again, we are on pace to be another record-breaking year in terms of low real estate volume. So what happens when people lose their jobs? People pump the brakes, like Dave said. They don't want to buy houses. Then the inventory starts climbing. There's still people that want to sell houses. So we start to see more inventory. What has kept our housing market so insane has been the lack of inventory, less than 2 months of inventory. When we talk about inventory, that means at the rate I'm selling houses today, if I say 2 months of inventory, if no new houses come on the market in 2 months, I got no more houses to sell. It's been 2 months or less in most markets, and that is now climbing with it being up 10% year over year in terms of inventory. As inventory goes up, typically, if there's not a buyer pool to meet the demand, prices will come down. But here's the problem. With us having such low sales volume to begin with, there's not much lower for sales volume to go. So will there be downward price pressure? Yes. Will we see some price reductions? if we hit full-blown recession? Yes. But will it be these dramatic, sweeping 40%, 60% things that we saw in the Great Recession? I'll ask Dave for his answer in a second, but my answer is no. I don't think so. We don't have that far to fall from a volume perspective, and we also have over 56% of mortgagees having major equity. Like 65% equity, I believe, right now. Like 56% of mortgagees have 65% equity in their home. If we lost 20% in home values, that would go down to 60%. That's still way, way better than what we saw in the Great Recession. So I'll ask Dave for your answer, where you see prices going with this recession.
Yeah, Rich, I agree with you. We're going to see moderate decreases, but it always comes back to supply and demand. And there's a shortage of housing, and there still continues to be the shortage of housing. And, a lot of this is market based. So if you're in some markets, it might be a little bit different. In our market here, Northern California, Sacramento, El Dorado, Placer counties, there is not any of these counties like a glutton of inventory. We haven't seen that for a long time, and that was the difference. Going back to the Great Recession is, financial crisis is inventories were spiking up like crazy, and there was also things that were called
like 18 months at the peak.
Yeah, and even shadow inventory where people had foreclosed and lost their homes, and banks were not releasing those homes, so people wouldn't even have known that those were vacant homes coming on the market. So they did not, because that would have cannibalized the entire market. So that was a whole different ball of wax compared to what we're seeing today. And to your point, Rich, it's like a lot of people do have a lot of equity in their home, and if their home drops 10%, it doesn't matter if they weren't going to sell it anyway, right? Because obviously you always want your home value to continue to increase over time. Unless you're in a market or you're needing to sell, if a small hiccup and your value comes down, doesn't really matter, because when your house increased by 10%, like, I'm going to sell it right now, I just got a 10% bump. No, it didn't matter, right? Unless you were in the market and you needed to sell. So, I think a lot of folks, unless you're in a position where you either want or are planning on downsizing or getting, relocating, probably no real motivation to sell. So we're not going to see a lot of inventory coming on the market.
Yeah. And we also are going to see the only real way to dramatically affect inventories to just build more houses. And there's lots of barriers to that in terms of environmental regulations and zoning laws and all that. It's a challenging and expensive thing to do. As we enter into a recession here, the builders are facing two things: the continued threat of tariffs. Right now, to be clear, the initial round of 25% tariffs on Canada and Mexico, Trump exempted those from the building materials, from the wood and the gypsum. Then this most recent, the Freedom Liberation Day tariffs didn't hit the building industry there. So like the CEO of Lennar has said, actually, we haven't been hit yet, but we are expecting to be hit, and we're expecting it to be now. It started out like a month ago. Go back and watch one of our podcasts. We were at like $6,500 is what they thought it was going to raise the cost of a new construction home. Now they're at like $9,200 is what Lennar is thinking it's going to go up to. But they haven't been hit yet, but they're expecting to be hit. There was even a leaked memo from the Department of Commerce saying they might be using some anti-dumping laws to put in another 34.4% tariff on lumber on Canada and Mexico. That may or may not happen. That's not actually happening. It was a leaked memo. But with the threat of costs going up and people losing jobs, these home builders have to decide, do I want to have standing inventory and get left holding the bag here? Do I want to build homes I may not be able to sell, or may not be able to sell at the prices I need to sell to get profits? So my profit margin is getting squeezed by tariffs, and my buyer pool is getting squeezed by recession and job loss. I'm going to pump the brakes and stop building, or build a lot less. And that will exacerbate our low inventory problems. So as you have the downward price pressure from nobody buying, you have the upward price pressure of still very little inventory for the people who are buying. And we're kind of locked in this back and forth that is not necessarily good for the housing market, but will keep this from being a massive blow to the housing market if this goes full-blown recession.
I agree.
What's that, Dave?
If you've ever driven by and you look at a new home development, so the one thing you got to understand is, like, a lot of these new home developers, they already own the land. Sometimes they've owned the land for 5, 10, 15 years, and they're making a decision of when they're going to build on it. And if you go into a new development, and for anyone that's driven into these, you might see, 40 homes being constructed at once. And to what Rich is alluding to, now you're going to drive in a new home development where they have more lots available. Now they're not building those lots until they have offers on those lots. So,
Yeah.
skin in the game, so to speak, and a predetermined price on those versus just building them as fast as we can in 10, 15 lots at a time, knowing that we're going to sell those because there's enough people coming through and enough demand. So now they're just going to, slow that way down, and it takes a while to speed back up. So,
Yeah. So I know we have thrown so much economic data at you, and there is so much out there to track. What I would boil it down to is this: watch those jobs numbers. If the jobs numbers go down, then that likelihood of recession goes up, and we are marching our way towards recession. If we're marching our way towards recession, how is it going to affect you? If you're an existing homeowner, maybe you can't refi and pull money out because you have lost some equity. Or maybe you can refi and pull money out because you were at a 7% interest rate, and now we've gotten into lower interest rates, 6%. Again, we don't see going to fives. We've got another podcast about will we see 3% again? Short answer is no, but go ahead and you can watch that one for the detailed answer. But we could get into the low sixes, and at that point, if you're in the sevens or high sevens, you could have a refinance opportunity, either pull money out or just a rate and term refi and bring your payments down, which is a great thing to do in the recession. So as a pro, there will be some refinance opportunities coming up, and look for a future podcast, maybe even next week, that we'll be talking about how to evaluate whether or not it's the right time for you to refinance. You may see prices come down a little bit, so it may make affordability a little bit better for some of you. If you are a well-qualified buyer, you could get a better deal on a house and a lower interest rate. And so affordability gets better for those of you who have stable employment. We have another podcast on 5 things that you should evaluate for yourself to know whether you're a stable buyer or not, whether you're the type of buyer who should buy regardless of what's going on in the market. Watch that one, evaluate yourself. For some of you, this is going to be a great opportunity. And for those of you that are on the ragged edge, you've been saving up for a house, affordability has kind of kept you on the sidelines, and now you're worried about your job and you've got some fears. Maybe you don't have a good emergency fund or some of these other things we talk about in that podcast. It may be the time for you to pump the brakes and wait and watch and see. And we're going to continue to bring the updates as we can, as they come, so that you can make an informed decision. But I think for now, if your big fear is the housing market completely going to hell in a handbasket, I don't see that on the horizon. Do I see a correction coming? Yes, I do. Do I see in the short term, maybe even prices going up before they go down? That could happen as these tariffs make the cost of new homes go up. Maybe there's a flight to residential resale homes. Maybe prices go up short term. And then once more people lose their jobs, we see that correction. So there is even a chance that affordability gets a little worse for a short period of time here. We're going to keep you updated on that as usual. Thanks for making it to the end. Dave, we hit 32 minutes talking about Trump tariffs again. I look forward to a point in the future where we can have a whole episode where we don't use the word tariff. Thank you guys for watching. Thanks for being dedicated to your own financial education. And Dave, thanks for being with us.
Thanks, Rich. Thanks for having me.
We'll see you on the next one, guys.